Yes,
Yes,
ma'am.
ma'am.
Now it's visible.
yes.
Right. Okay. So should I start from beginning or can I start from this point onwards? Okay, let's continue. So, as already told to you that we have this, I have discussed about this capital and revenue expenditure, rather hinted on what is capital expenditure and revenue expenditure in a previous session. In this session, we would be extending our discussion on capital and revenue expenditure. And after that, we'll be discussing revenue recognition, and then we'll take our discussion, if time permits us, to accrual accounting. Because it's important for us to understand accrual accounting if we want to understand how the adjustments are being carried out in final accounts. Right. So, capital and revenue expenditure. First of all, tell me, what do we mean by capital expenditure? Before I start, you tell me what is the meaning of capital expenditure. Yes, please. What is capital expenditure?
It is adding more and more money from the proprietor to the business.
Okay. Anyone else?
Ma'am, amount spent on acquiring assets.
Yes, very right. Amount spent on acquiring assets. Okay. What else? What is capital expenditure? Okay, what is expenditure? What is expenditure? Expenditure is about spending money. Okay. Spending money to acquire something. Before I discuss something, I think we can discuss one important, excuse me, sorry. Okay. One important aspect on this, that we have two things we all know about this. One is income statement, another one is balance sheet. Okay, so you have balance sheet. On balance sheet, we have assets, we have liabilities, right? On income statement, we have income, and here we note down all the expenses. So what the business is actually doing? The business is doing is this, that it has raw material that it takes and converts into work in progress, and then it takes it to like finished goods. Those finished goods are being sold in the form of sales, and the sales can be credit sales as well, and then you get cash, and then you can buy further raw material. What do we call this circle? What is the name that we give to this circle?
Business
What do we
cycle.
call it? It is known as operating cycle. Okay. So what is happening in an operating cycle? What do we have? What is raw material? The question here is raw material an asset or a liability? What is work in progress and finished goods? What is finished goods? Leave raw material. Tell me, what do you mean by finished goods? Is it an asset or a liability?
Asset.
It is an asset. Okay. And what have you done to acquire this asset? You spent some sort of cash. What is cash? Is cash an asset or a liability? Cash is another asset. So you spend one asset to acquire another asset. So this in another asset, then you go for sales. That gives you income. And if the sales are On the form of credit sales, you get debtors, which is another asset. So on the way, when you were acquiring this asset, what if you don't have a cash, or you buy this raw material or this finished goods on credit? Then you have created liability. So what happens is, here we have the first chunk in liabilities is capital. The capital can be equity or debt. Okay, this capital is spent to acquire assets. Assets can be stock, it can be machine, it can be anything that is related to keep the operating cycle running. Okay. So now this is a process of converting your capital, which is your liability, into an asset. And this process is what do we call this as expenditure. You are making an expense in order to create assets. Now those assets can be either a long term asset or it can be a short-term asset, depending on what the business, where the expenditure has been made. Now, this is made. So, if the expenditure, it could have happened that you spent a part of your capital in making payments for, you spent a part of your cash or your assets in making payments on electricity bills, on rent, on salaries. What are these rents and salaries? Rents and salaries. They are also expenses of the business. So rent, salaries. This is what you pay. And on what do we get on this side? What is the result of this operating cycle? What do you get as a result of operating cycle? Yes,
revenue, revenue and profit.
revenue. Right. So we get revenue or we get sales as a result of our operating cycle. And this sales, after reducing all the expenses, gives you net profit, and this net profit ultimately goes back to your capital, and then you run your operating cycle next year. Right. So this is the whole idea. But the point I wanted to make here is, when I was discussing this revenue expenditure and capital expenditure, is that whenever there is an expenditure that has happened in the organization, it results into the running of operating cycle. But the nature of the expenditure decides whether the expenditure is a capital expenditure or a revenue expenditure, right? So when the expenditure is of a nature which leads to creation of long-term assets, then we call that it is a sort of capital expenditure. But if the expenditure of such a nature that it creates short-term assets, or it has been carried out in order to spend on those assets which get recover itself in uh, from the revenue of that year, then we call them as revenue expenditure. Now, what is the reason of this rent and salaries? Are they leading to creation of some sort of asset to the business? Does rent and salary led to creation of any asset for the business? You kept the land for 1 year. You used the building for 1 year. Building was an asset, but you paid a rent on it. So you had a short-term asset. You held a, what is rent? Rent is cost of using a building. Okay, so cost of using a short-term asset. What is salaries? So salary is the cost of using human resources. So cost of using another asset for a short term. What is short term for us? Short term for us is an operating cycle. The point I want to make here is, any sort of expenditure that is done in order to use an asset which recovers itself during one operating cycle is a revenue expenditure. But any sort of expenditure that is done to acquire an asset which takes years or more than one operating cycle to recover itself, is a capital expenditure. This is the basic underlying distinguishing point between the capital expenditure and revenue expenditure. Rest of the things are just story. Am I clear on this? So that I can now we can build up the rest of the story on this foundation. Is it okay?
Yes, ma'am.
Okay, now let's see. So when we were talking about capital expenditure, we were talking about it's an expenditure. Generally, it is being said that it is spent on acquiring assets. But this assets that we are going to acquire through capital expenditure are long-term assets. Why they are long-term assets? Because they will take more than 1 year to recover themselves. How do assets recover themselves? They recover whatever the business is making, it is going to recover itself. It is going to recover through revenue, through sales. And when I say how the business is recovering, which accounting concept am I referring to? When I say this thing, that business is making an expenditure which it is going to recover from the revenue, which accounting concept am I referring to?
On revenue recognition or realization.
No, I'm referring to actually the matching concept. What is matching concept? This year's revenue should recover this year's we should recover this year's expenditure from this year's revenue, or we should match the current year cost with the current year revenue. This is the concept that we use when we talk about matching concept. Are we together on this? The matching concept. This year's revenue should be matched with this year's expenditure. That is the that is the matching concept. Revenue recognition concept is different. It says when should you recognize the revenue. It's an interesting concept. So broadly speaking, that if you can match current year expenditure with the current year revenue, which expenditure are you referring to? Capital expenditure, or are you referring to revenue expenditure? You're referring to revenue expenditure. So let's have a simple understanding of expenditure. Expenditure is something, some sort of money that is spent in order to acquire an asset. If the asset is a long-term asset and is of a non-recurring nature, it becomes a capital expenditure. Whereas on the other hand, if the asset is of a short-term nature and is of a recurring nature, and you recover the same asset from that year's revenue, it becomes a revenue expenditure. So now that takes us to the distinguishing. Now we are ready to distinguish between capital expenditure and revenue expenditure. Let's have a look. What do we do with the capital expenditure? We acquire long-term assets. When we say we acquire long-term assets, what are we referring to? We are referring to long-lived assets or fixed assets. So revenue expenditure is done to acquire fixed assets or long-term assets. Whereas revenue expenditure is done to acquire those assets which are of short-term nature. That means they will be recovered through the revenue of that year. That means we would be in a position to meet the running expenses. That is revenue expenditure. Capital expenditure is an external transaction. Okay, it happens with the business, but not with the customers. The business is not transacting with the customers. It is acquiring fixed assets. Whereas the revenue expenditure is also a result of internal transaction because the business is interacting with the customers and it is trying to recover the expenses of the given year. Example, one of the easiest example of internal transaction is depreciation. And whenever capital expenditure is done, we lead to an increase in some sort of asset because you've acquired an asset. So that means there would be an asset account that would be debited. Whenever there is an increase in the asset, we debit it. Whereas in case of revenue expenditure, we debit an expense account. Capital expenditure is of a real account, whereas revenue expenditure leads to creation of a nominal account. Where do we place a capital expenditure? Capital expenditure gets its place in the balance sheet, whereas revenue expenditure is placed in a profit and loss account. And why is that happening? To me, this is the most important point, because this point is actually giving rise to all the other points. Because this is getting guided by which concept? The matching concept. Okay. Now, since it's a long term asset, it would be a non recurring nature, whereas it's a short term asset, it would be a recurring nature. And what is matching concept saying? Matching concept say that you need to match current year's revenue with the current year expenditure. All the revenue expenditures will be matched with the revenue receipts. What are revenue receipts? What do we mean by revenue receipts? What is the meaning of revenue receipts? Sales. The meaning of revenue receipts is sales. What is the meaning of capital receipts? Gain on sale of asset. You sell an asset. That is a one-time event that is happening in a company. You sell an asset today, that is a long-term asset or a fixed asset. Suppose you sell the land that you had with your organization for long term, and you're selling that. You made a sale of whatever gain or whatever receipt you had on the sale of that land is your capital receipt. Okay, now the one second next important point. Eventually, all the capital expenditure becomes the revenue expenditure, whereas revenue expenditure does not become the capital expenditure. What does it mean? Now, see, this requires our discussion. You need to indicate me. If you know this beforehand, then we will spend less time. Otherwise, we'll discuss this in full. So, what is capital expenditure? Example, anyone please turn on your mics and tell me. Capital expenditure. It leads to acquisition of fixed asset. It's of non-recurring nature. So you have created a fixed asset. Where do we show the fixed asset? We show it in balance sheet. Is it coming in your profit and loss account or income statement? No, it's not coming. So what do we do once we enter it in the balance sheet? We start depreciating it. Depreciation is charged each year. And where do we place this depreciation? We place this depreciation in income statement. So what is happening here? So once this depreciation moves to income statement, what is this depreciation? This depreciation is revenue expenditure. And what is the effect of this depreciation? What is the net result or effect of this depreciation? Leads to reduction of in the value of fixed asset. That means what? You are eliminating capital expenditure. So you're eliminating the capital expenditure. So ultimately, this value of capital expenditure, let's suppose example, it's a 1 lakh. And each year you are depreciating with 20,000. So each year you reduce a part of this capital expenditure 1 lakh, you reduce it and take it and make it a revenue expenditure. In order to, what do we do when we make it a revenue expenditure? What are we doing actually? We are recovering it from sales. So that means you will be charging this depreciation against the sales, and thus you create this capital expenditure. You convert this capital expenditure into a revenue expenditure. So whenever there is an expenditure that has happened with the that has occurred in a company, like acquisition of fixed asset, we capitalize this expenditure and create a long term asset and show it in the balance sheet. So capital expenditure is, or an expenditure is capitalized, whenever there is an expenditure that is capitalized, it will lead to creation of a long-term asset that is recorded in the balance sheet. And once a capital expenditure has been capitalized, we eliminate it, or we divide it into small parts, and each part is charged against the income, that is the sales, in the income statement each year. Thus, this capital expenditure is expensed each year as revenue expenditure. This leads to what is happening. Your capital expenditure is getting converted into revenue expenditure, but over a long term. This is the main idea that that I wanted to discuss. Rest everything is very simple to understand. You don't acquire. You can have a look that rest of the things are quite simple. The few things that require your attention is that this all is occurring because of the matching concept, and it's whenever you need to eliminate the capital expenditure, you'll have to convert it into a revenue expenditure, a part of it, and then you can write it off because you're ultimately following this matching concept. And revenue expenditure is not matched against revenue. Sorry, capital expenditure is not matched against revenue capital receipts, whereas revenue expenditure is matched against revenue receipts. What is the meaning of this? The next important point is this. Okay. What's the meaning of this? That you have capital expenditure, and then you have capital receipts. You have revenue expenditure, and you have revenue receipts. Okay, revenue expenditure is matched against revenue receipts, whereas capital expenditure is not matched against receipts. It is matched against revenue receipts, but in parts. Am I clear on this? Because if it is clear, then I'll move ahead. Otherwise, I would like to explain this. Yeah, is this clear? I'm saying that revenue expenditure is matched with the revenue receipts, whereas capital expenditure is not matched with the receipts. Capital expenditure is again matched with the revenue receipts, but this is divided in parts. This is distributed in parts. You cannot match the complete capital expenditure with the capital revenue receipts. You'll have to divide the capital expenditure into small parts, and then only you will be in a position to match it against the revenue receipts. Right. Is this okay? Okay, great. Now we can move ahead. So let's have a look at how do we distinguish between revenue receipts and capital receipts. The simplest form of revenue receipts is the receipts that the business is receiving because of its core business activities, the revenue receipt. If the business is into the trading of, or is into the trading of cloth or any sort of commodity, then whatever the sale receipts that the business is having because of that trading activity is the revenue receipts. Okay, even though the business is into there is some sort of business which is into the sale and purchase of land or real estate, then the revenue receipts from that transactions will be part of revenue receipts. Whereas the sale of anything which is part of the balance sheet, okay, asset side of the balance sheet, if there is some sort of asset on the balance sheet and that is being sold by the company, except inventory, that would result into capital receipts. So we understand this thing, uh, but there are few more the further points that require distinction is that revenue receipts are recurring in nature because they are result of operating cycle. Each time your business would finish one operating cycle, it would lead to generation of revenue receipts. Capital receipts are not result of your operating cycle, so that is the reason why their timeline cannot be fixed, and the performance of the company can also not be assessed with the revenue receipts. Whenever we would expect to make an assessment of the performance of the company, we would look at the growth in the top line or what is the occurrence of revenue receipts. Here, there is one question that I would like to ask you, but I don't because it's a beginning level course, and if you don't know the answer, then also it's fine. But those who have commerce background would be otherwise also. Uh, if I want to check the asset efficiency of the business. Okay, my question is, if I want to make an assessment how much efficient the business is in making use of its asset, which type of receipts should I look for? Capital receipts or revenue receipts? I want to check how much efficient the business is when it is running its operating cycle or when it is using its asset. Is the best business good enough to put its asset into use or to achieve its stated objective? What type of receipts will catch my eye? The capital receipts or revenue receipts? What do you say? Yes, revenue receipts. Why? Exactly. Revenue receipts are indication of the operating activity of the business. Okay, are indication of how well the business is performing its operating activity. And thus, it's the revenue receipts which are indicative of the uh, efficiency of the assets being used by the firm. Okay. So if a business is having heavy capital receipts, what does that mean? What does that indicate? Have heavy capital receipts. Cash is coming. Yes. No. First one was right. But if the heavy capital receipts, how the business is generating so much of capital receipts? It is selling its fixed assets. Though the cash is coming, why is it downsizing itself? It's an indication of shrinking of assets or getting rid of old assets to acquire new assets. I have to check the context here whether the business is reducing its size, getting lean, or whether the business is getting rid of old assets in order to acquire the new assets. Either of this can happen. Okay, so that is the indication of revenue receipts. Now, with this, we can look at the points that are important for their distinction. Is revenue receipts are not available for distribution of profits. Why? Because they are not part of why? Because they are not part of operating activity. Whereas revenue receipts are available for distribution of profits. Revenue receipts are utilized for creating reserve funds. Whenever you need to create a reserve fund for the business activity, we would create it through the revenue receipts. Whereas capital receipts are generally not utilized for creating a reserve fund. Otherwise, what would happen? Whenever you require a reserve fund, you can sell off an asset, acquire capital receipts, and create a reserve. It's an indicator of bad health of a company. Even though there are no capital receipts, we don't make an assessment of the survival of the business with capital receipts. Zero capital receipts, yet the business can have 100% survival chances. Whereas on the other hand, revenue receipts growth is very much essential, important, and looked for is as an indicator or survival of a firm. Capital receipts are sources for creating capital reserves, but not for other reserves, whereas revenue receipts are the sources for creating revenue reserves. So that was about capital reserves and that was about capital expenditure and revenue expenditure, capital receipts and revenue receipts. Now I think we have two choices. We can either go for accrual accounting, or we can go for that, what do we say, revenue recognition. What do you want to discuss? I think with this we can discuss revenue recognition, right? So let's move on to revenue recognition. What is revenue recognition? Okay. Now tell me, is this slide clear, visible to you?
Yes,
Okay.
please.
Now, what is revenue recognition? It is very much important, and the revenue recognition principle is so much manipulated that it is one of the key source of identifying a red flag or an irregularity in a financial statement of a company. This is so much important, and this is the reason why revenue recognition is important. Because another reason is, it is the point where companies can play around. They can create a magnifying effect for the profits. They can create a magnifying effect on profit by just playing around with the revenue recognition principles. And we had recently a very good case in India, for which has where a big company tried to play around with the revenue recognition principle. So this is very much important. As we have discussed, receipts, capital, revenue, we know this thing. And now the time comes, revenue recognition. But why do we need to understand? But before we do that, tell me, what do you mean by recognition of revenue? Before we start with this, but what is revenue recognition?
Record their revenues.
Yeah. So, revenue recognition tell us, when should we recognize the revenue? When should we state that yes, we have earned the money through the sales? That is the aim. So, revenue recognition criteria depends on whether the revenue is realized, realizable, or earned. There are 2 points that we need to take into, whether we have realized the revenue, whether it is realizable, and whether we have earned the revenue or not. So the key terms here are realized and realizable. What does this mean? This means that the seller's net assets have increased. That is the meaning of realized. Or if we take it in a layman's language, that means I have received the money, or I have received the amount of cash which is related to, or to the sales that has been made. Okay. Whereas earned, what does earned means? What is the meaning of earned? What is the meaning of earned? Earned here means that the seller has performed all the duties under the agreement of sales accounting, or sales agreement. So that means accounting for revenue is actually very complex. Much of the complexity that arises is because of the transactions that we have, right? So we must understand what are the sales transactions. So in order to do that, we must understand the business of the entity, how the business is performed, what is the nature of each sale that has taken place. So what is the nature? That is the key point in order to understand that to properly account for the sales transaction, we must understand what is the nature of each sale, how the sale takes place, what is the process of sale, and how the business of each entity takes place, so that we can understand and place it along the timeline of the operating cycle and accounting period. That is the important point. Now, whether I should recognize the revenue this year, next year, or shouldn't recognize at all. This is the point where companies generally uh, play some sort of gain and create an irregularity. So the two key questions that are required for understanding the sales is, what is being given up and what is being received. Means as a company, what has been given up and what has been received by them. Normally, both of these questions are answered in the sale agreement. So now first question is what is being sold. That means I need to answer what is being sold. So sale transactions, what happens is whenever there is a sales transaction, there is a transfer of goods, there is a transfer of services, or there is transfer of both. That means it can be a bundle of goods and services. When we talk about sale of goods, what are we referring to? We are referring to all type of tangible assets that has been sold. Like there is a tangible asset. That means once the good has been transferred from the seller to the buyer, uh, the sale has taken place. Whereas in case of sale of services, what happens? We transfer the legal title along with the possession. Is it relevant? Can you possess the service? Can you possess the service? The points are legal title plus possession. Possession here refers to control. Possession here refers to control. In case of goods, legal title is can be passed easily. Possession means control can also be passed easily. Whereas in case of sale of services, both of these become irrelevant. They cannot be passed on. And in case of bundle of goods and services, sales agreement become very much important because now the complexity of a transaction has increased. It involves the transfer of legal title and control in part of the contract, and some part of the contract does not involve that. That takes us to the next question: what is being received? How the reciprocal of the transaction has been carried out by the customer. What has been received by the customer, what has been received by the business from the customer, whether we have received it, what is the way of consideration, whether the consideration is in the form of cash or is it in the form of non-monetary returns. If it is in the form of cash, it's monetary, very simple, very easy to measure. If it is in the form of non-monetary returns like other goods and services, then it's a form of barter and the valuation will have to be considered. But whatever is considered is that the value of deliverable that has been sold is value of consideration that has been received. But here we have one star that takes place here. That star indicates that the transaction has taken place at an arm's length distance. That is the meaning of this value of deliverable sold and value of consideration received. But it should not be a related party transaction. Otherwise, we won't be in a position to make an assessment of fair value that has been received as part of sale. So that brings in more clarity to the point of recognition of revenue, because the transaction is not taking place between relatives, it is taking place between the business and the customers. Now that takes us to other terms that are required, which are related to either legality or the concessionary terms, which is like under normal circumstances, what is the payment policy, what is the credit extended, why is the selling price deeply discounted, why it has been discounted, uh, what type of extras that have been or frills that have been included as part of sales transaction. And in legality, what do we discuss? We discuss what are the rights and obligations of sales transactions and how they are described in the contract and governed, how they are governed by the law. Okay, so here the contract law uh, is important, and the information of that is important in order to make an assessment whether I should recognize the revenue or should not. Okay. So now it takes us to the approaches to recognize revenue. Since it's a course of a beginning level, I'll be discussing only asset liability approach. Rather, there are two approaches: asset liability approach and earnings approach. Focusing on asset liability approach, it takes us that if we want to recognize the revenue for a company, there are five key points that must be considered. The first one is identify the contract with the customer. Okay, identify the separate performance obligation in the contract, determine the transaction price, allocate the transaction price to separate performance obligation, recognize revenue when performance obligation is satisfied. Now, let's take up an example and let's have a discussion on an example in order to understand these 5 points and build up a comprehensive understanding of revenue recognition. And after that, I'll discuss a very important example or a recent case that has happened with revenue recognition and few others that have happened in the past and has made this revenue recognition a very important aspect or a very important point for a student of a business to understand, not only of accounting, for a business as well. So when we say identify a contract, what do we mean? It's a contract between two parties that creates enforceable rights between them, right? So let's take one example that there is an airplane. There is a company that has signed a contract. So let me write the name of the companies. There are two companies. One is Boeing, another one is WestJet. So Boeing said it will be delivering airplanes to the WestJet. Okay, this is the contract. And who is the customer in this case? In this case, the WestJet is the customer. Now we need to understand what is the separate performance obligation in the contract. What is that obligation that makes the contract to be completed from the perspective who would be recognizing the revenue? Boeing will be the one who would be recognizing the revenue because he is the seller, right? So in this case, so Boeing will have to do one thing, that is to deliver airplanes to WestJet. Okay, now this is the promise that it has made. Once it delivers to the WestJet, the contract will be over. But the third point that requires it, what is the transaction price? Now Boeing has said it will be delivering for 100 million. Now this is the transaction price that has been defined in the contract. Now the next point is allocate transaction price to separate performance allocation. In this context, we have only one performance obligation. In some cases, there can be a number of performance obligations. For example, if Boeing would have said that I would provide you airplanes, along with that, I would provide you the first service of those airplanes after 6 months. So the contract would not be complete with till the 6 months. Okay, so here in this case, we have only one performance obligation. Whereas now recognize revenue when each performance obligation is satisfied. This is where the companies or where an organization need to pay attention. When would Boeing recognize the revenue? Boeing would recognize the revenue of 100 million for the sale of airplanes to WestJet only when the WestJet has taken possession of the airplanes. Possession here means the legal title is transferred, plus the control on the airplanes is now in the hands of WestJet. That is where the revenue is recognized, right? So this is about revenue recognition. Uh, this is about revenue recognition, but the points that are important here, with which we started our discussion, is what is the most important point? The fifth point is the most important point. The timing of revenue recognition is important. Now we understand that we can recognize revenue, but when should I recognize the revenue and how much revenue should I recognize? So, why the timing is important? Because it has a direct impact on the net increase of the amount of revenue. Your revenue increases, your sales increases, it indicates that the profit has increased. It directly impacts the profits and the directly impacts the valuation. It reduces net income by triggering the recognition of certain expenses as well. So whenever you recognize a revenue, you'll have to match it with the revenue expenses. So it will trigger the recognition of certain expenses. Now, as I told you that we will end this session by discussing a case. So I would like to ask you, does any one of you know what happened with Baiju's financial statements in year 2021? Why Byju's was in so much in news in year 2021? What was the reason? What was the reason for that? Yeah, I can come back to this. Now, tell me what was the reason why Byju's was so much into news when it was like into year 2021? That was one of the aspects why Byju's was in news. What happened in year 2021? The auditor of Byju's refused to sign its financial statements, and the reason for that was they said that you rectify your errors related to revenue recognition. Okay, that was the reason. When it came, like, their Byju's enter into a contract with the parent for delivering the services related to teaching, right? Teaching of a course over next 2 years. And when the contract is signed, the customer pays 20% down payment, and rest of the payment would be made in the next 2 years when the course would be delivered to the customer. Right? So ideally, how much revenue should Byju's recognize? Should it recognize the complete 2 years revenue which it has not received as earned, or should it recognize only the percentage of the revenue that it has duly earned? That was a point where it played. What it did is it recognized the whole value of the contract as revenue earned. Okay, and inflated its financial statements. And that was the point when the auditor, that was, I suppose, was Deloitte, refused to sign and then say, you modify, you correct this. And then they corrected their financial statement, and thus they recorded huge losses because of the financial position of the company. So that's one thing. And another one thing, one very classic case, that was of Enron. Enron also manipulated on the revenue recognition principle, and what it did, it recognized all the future cash inflows which it will receive in future as that day's cash revenue, and inflated its financial statement. It's one of the classic case, and it's discussed as a accounting fraud as well. So that is an irregularity. The point here is recognition is very much important, and companies try to play around this principle because it gives them the leverage. There was once what happened with Reebok. What it was doing is it recognized all the revenue appropriately. It didn't do anything, but it stopped or it refused to recognize the bad debts, and kept those bad debts in its books as doubtful debtors or good debtors, right? So good debtors, keeping them as good debtors, that means keeping them equal to the revenue that has been earned. So that's actually not revenue recognition, but companies play a lot when it comes to revenue recognizing and all that. Right. I hope that that's all for today's session. In case you have any question, you can ask me now. There is some. Anyone having any question? Otherwise, we can close the class. Yes. Hmm. Hmm. हाँ बिल्कुल. No, that is separate thing. They said that you take loan. Okay, that is separate. But what the point I want to make here is, okay, given your context, for example, how much revenue should the company recognize? 20,000 or 1 lakh? Yes, you're right on this. Yeah, one lakh. It hasn't earned as well, na? It hasn't delivered the service till now. It cannot recognize that much of revenue, and that is where the whole hue and cry was. But Byju's was intelligent enough to recognize and to amend its financial statements according to the required law. नहीं नहीं क्यों नहीं मैच करेगा. हाँ. Is it always that you receive all the revenue in cash? जो revenue cash में नहीं होता, where do you indicate that revenue? Debtors में कर देते हैं ना उसको. Balance sheet तो match होगा. Increasing revenue means increasing profit. Okay, okay. Anything else?